If you're not familiar with it, EFAMA was one of the co-founders of the first retirement week, which took place 4 years ago. Now it's great to see that it has become a regular fixture of the Brussels calendar held in the last week of November. This year's event feels especially timely. Only last week, the European Commission published its recommendations and proposals on supplementary pensions. We will try our best to link the report with the developments later today. But back to the European Retirement Week. It has two main objectives. One is to debate the future of pensions and ensure pension adequacy in Europe. And two, to raise awareness among EU citizens about the importance of saving for their retirement. Today's webinar focuses very much on the Retirement Week's first objective, thinking about the future of pensions in Europe. We are doing this by looking at a recent piece of research from McGill University, one of Canada's top-ranked universities. This research was done in collaboration with ALFI, the Luxembourg Investment Fund Association. We are lucky to have two authors of the report with us today, Patrick Augustin and Sebastien Betermier, both finance professors at McGill University. Patrick and Sebastien will walk us through the report and share insights on why some European countries are lagging in turning household and pension savings into more productive investments and what this means for their retirement systems. We also compare countries with more productive pension systems, kind of highlighting how those that decades ago shifted to partly funded pensions are now in a much healthier position. Before I hand over to Patrick and Sebastien, I'd like to bring Corinne Lamesch into our conversation. She is the Deputy CEO of ALFI. Thanks for being here today, Corinne. Perhaps you could set the scene for us. Explain why ALFI decided to compare pay-as-you-go pensions with those of partly funded investments. Look, I imagine there is an interesting background here, especially since Luxembourg features on the list of pay-as-you-go countries in the report. Corinne?
Thank you, Andreas, and good afternoon to everyone. Thank you for having us today on such a really important topic. Actually, Andreas, the idea for this collaboration and this report stems from the renewed savings and investment union strategy. I think there was a broad recognition that pensions could play a very big role in creating deeper capital markets. This was an area which was always left to the member states, mainly to the member states, and the European Commission in their SAU strategy have pointed out that pensions are critical and that there should be more coordinated way in Europe to deepen or to increase pension savings. And so, I mean, let's just take a very quick step back. I think that we know that Europeans save 5 times more than Americans, but we also know that they have much less wealth. And so the reason for this we know also, and it was mentioned by many reports during the SIU, is that indeed Europeans do not invest, and more than 10 trillion of savings are sitting in cash deposits. And it's also a fact that many of the EU member states still largely rely on the first pillar pay-as-you-go pension systems. And we also know that due to the evolution of the demographics, those pay-as-you-go systems will inevitably be unsustainable. Mm-hmm. We also know that pay-as-you-go systems are expensive and weighing heavily on public budgets. And yes, you mentioned Luxembourg. Luxembourg is in that boat together with many other European countries. However, we believe that one of the biggest levers for the SIU is if we would transition the EU's pension systems from partly funded models to really the funded models which exist in some of the main, or let's say already some European jurisdictions, but also some other outside of European jurisdictions. And that's where we thought, okay, there are already best-in-class cases out there, and we should learn from them, and we should try to see what could be done at a broader level in order to make this shift. And as you will hear, this shift is not easy, and it's not one layer. And I'm not going to steal the thunder, so I'm going to stop here. But it is a very complex journey. But there are some countries in the world who have managed this transition. So I guess let's look at it already. Let's look at what they have done.
Look, thank you very much, Corinne. I think it's both very good insights, but also very good teaser of what's about to come. Before handing over to our main speakers, please also all of you know that we've set aside some time for questions after the presentation. That said, we have the chat function here in the webinar. Please feel free to use it at any time. I'll try to monitor it and try to see whether we can pick your questions up during or after the presentation. Now with, I think, everything set, I think I can turn to you, Patrick and Sebastian. Thank you very much, I'd say, for your patience, and the floor is yours.
All right, thank you very much, Andreas, for this extremely kind introduction. It's a great pleasure to be here today and to be allowed to speak on this super important topic, as both you and Corinne pointed out, and to present and discuss some of the key highlights of the study that I did together with my co-author, Sebastien Betermier, who is here with me in the call today. And both of us will walk you through this presentation and the study. But also, I should mention that it was co-authored also with Emma Gormley and Mary Parent, who are two of our outstanding students at McGill University. I also use this opportunity before jumping into the study to briefly introduce the McGill Luxembourg Center for Finance. So the study was co-authored by ALFI, so the Association of the Luxembourg Fund Industry, and this McGill Center. And it's a new center that has been created for McGill to increase its impact in Luxembourg and in Europe more broadly. And so as part of that center, we will also be launching a new master program in Luxembourg, which is designed for working professionals, and where, among other things, we also have courses on pension funds, again, relating to this topic, but also to the asset management and capital markets more broadly. So if anyone has interest in that, I kind of encourage you to reach out to me or kind of go to our website and learn more about this. But for now, that's all I want to say. This is about the retirement week, and let's focus on Europe's productive capital gap. All right, so basically, what's the kind of the starting point for this study? So I think, as has been pointed out numerous times, our starting point is the fact that was basically kind of very clearly disclosed in the Draghi report on the future of European competitiveness, which made it very clear that the gap in productivity between Europe and the United States has widened over time. And widened may be kind of an understatement, because we kind of a chiasm between kind of the real GDP that it was basically back in 2002, as well as kind of the latest data here in 2023. So already back in 2002, there was a big kind of a GDP gap in real terms that was 17% back in about 20 years ago. And so fast forward just a couple of years ago, kind of the latest diagnostic showed that this kind of gap has widened and that it's now as large as 30%. Now, obviously, there are many reasons why you may kind of see this gap or kind of this increased kind of competitiveness by the US. Some of those that are identified in the Draghi report, including regulation that's very prohibitive in Europe, lagging innovation, or kind of limited adoption of digital technology. But in particular, and I think that's where we come in here, is the weak capital formation. Now, if you think about trying to resolve the issue of weak capital formation, the natural place to look at is pension assets. And why? I think the reason is obvious, because pension assets are typically have a very long and predictable investment horizons. People save for the long run, right, for 30, 40 years down the road. And also, when you pull them, they're easily scalable into kind of sizes where you kind of have thresholds that allow you to actually kind of benefits from economies of scales, and to do have kind of an impact and use it productively kind of to support the economy. And so exposure to risky assets, right, supports also the long-term wealth creation, right, because it helps cushion financial pressures that we kind of do face from the increasing life expectancy, and that is kind of a common problem across Europe. Now, when you look at Europe, apart from some exceptions, it does turn out that most European countries do kind of are structured in their pension kind of systems through a pay-as-you-go system, where social security systems are organized in a way that you primarily have kind of a transfer system where kind of the current generation pays for the kind of the retirement benefits of those that are currently retired. And so one of the results of that is obviously that kind of it results in smaller funded pensions with less capital allocated to risk-bearing assets. So what have we tried to do? And basically, motivated by these facts, kind of the goal was to say, let's look at some of the countries in Europe that operate on a pay-as-you-go system, compare them to those poster child kind of candidates in Europe that we know have transitioned into very well capitalized kind of economies, in particular through their pension systems. And so let's kind of compare 30 years down the road, how does the wealth accumulation across the different kind of tiers or pillars of the pension ecosystem has evolved across these two types of countries. And so to kind of complement the story and not just look at European countries, we have brought in other countries like Australia or Canada that are also known to have kind of developed very well pension system or very kind of performant pension systems. And so that kind of hopefully from looking at these different kind of countries and case studies, we may learn something about best practices and maybe get kind of a roadmap in terms of what we should be doing if we want to reform our systems. Just to be clear on the definitions, when we talk about risk capital, we mean investments in public and private equities, real estate or infrastructure. And so when we talk about non-risk capital, we broadly refer to fixed income assets, right? Or like savings accounts, simple checking accounts. And so that's kind of the key or the rough distinctions that we make in this paper. Now, in case I lose some of you on the way, so I just kind of would like to point out the key takeaways that we have in this study. And so we're going to kind of dig deeper into these individual takeaways, but hopefully they will already allow us to kind of to shed some light on some of the key findings. Number one, what we see is that risk capital in uncapitalized regimes could be an order of magnitude larger if these countries had adopted pension reforms like those of Sweden or Australia, if they had adopted these 30 years ago. And so the order of magnitude could be 2 to 3 times X. What does that mean in euro terms? Well, today the accumulated risk capital in countries like France and Germany, just two countries that operate as a pay-as-you-go systems, are 5.6 trillion euros. And so had these countries, again, adopted more kind of pension reforms as those of the post-child countries that we're kind of going to be looking at, we would have roughly kind of 15.4 trillion euros of pension capital available that could be there to kind of to be used to invest into productive capital, infrastructure, right, adoption of green technologies, right, to support climate change, and so forth. So we're talking about a huge productive capital gap that we kind of quantify in this study. The second thing we see is that the capital accumulation and risk taking actually reinforce each other. And this creates a very powerful application mechanism because we see that as countries over time accumulate more capital, they also invest bigger shares of that into risky assets, and that is kind of reinforcing each other to really kind of grow capital more quickly and accumulate wealth more quickly in the long run. What we also see is that the third point is that you actually don't have a unique best practice for pension reform that will result in a very kind of highly capitalized system. There's multiple pathways that we see across the different pension studies, yet even though every way is different, there are certain kind of common takeaways that we will kind of look at and that really help us to kind of to think more holistically about various types of pension reforms. Now, while there's different drivers of risk capital accumulation or also different impediments across the different pension tiers, like I said, the paths are different, but there are some common takeaways. Another very interesting thing we discovered in this study is also that there is spillover effects across the different tiers of pension systems. So in particular, we see that as individuals get more exposed to risk capital through, let's say, the public pension system or through the occupational pension systems, this will make them more comfortable to also take on more risk through their individual and personal household savings. And so that creates an amplification layer that will clearly lay out, like highlight or illustrate in a couple of slides when we look at the actual data. Now, importantly also as well, like when we want to reform our pension systems, it's very hard to do this in an abrupt way. What we do see in those countries that have been successful is that the reforms have been gradual and they have been implemented gradually over time, right? So it's a gradual reform that takes time. There's educational efforts that are being involved. And so it's over the course of 30 years that we have seen these reforms taking place, and that now makes some countries turn out to be very, very successful. Last and not least, when we look at the various individual drivers, and we get kind of to bigger details on this a bit later on, we'll see that there are common drivers of risk capital accumulation that come back even though there are these differences in the pathways that lead to success. And generally, these relate to scale, cost efficiency, strong governance, that's very important, the broad coverage, as well as well-designed financial incentives. And another argument that I should have mentioned here as well is the portability of these products, basically across geographies and across jurisdictions. So let me jump in right into the framework that we'll look at. Now, when you look at different definitions of pension systems across the world, they're typically organized in the form of various types of pension pillars. Now, we wanted to move away from these because we think that a holistic pension reform requires kind of a more holistic view of this. But nonetheless, kind of to start our study, we have also organized like basically the different pension assets that we have by the level of the administration that kind of administers the various types of pension assets. So that with that purpose in mind, we try to kind of have it to kind of more clearly comparable to existing approaches, but yet kind of it has a slight difference in the sense that we look at, for example, what we call the tier one would be the public pensions that are like 100% or primarily administered by the state. Now, in some cases like Sweden, we see that there are some parts of that where individuals can also have a certain decision input to kind of to manage these funds, but generally the administration is fully kind of guaranteed by the state. At the tier two level, we're talking about occupational pensions where the administration is done through the employer. Again, the individual might have the ability to kind of make choices on the capital allocation, but the administration is done at the occupational pension plan level. And then what we call the tier three is basically individual or voluntary household savings that are 100% administered by the individual workers. We chose to look at 9 countries. And so the idea was to have 9 countries that have well-developed pension systems, but that are all unique in their, basically in the ecosystem or the way that they're being structured. Now in Europe, of course, the focus was supposed to be there, right? So we have the capitalized European systems like the Netherlands, Sweden, Denmark, and Finland, right? Again, which are all nowadays considered to be well capitalized, but they're still fairly unique in the way they're set up. And we'll talk about some of these cases in a bit. And so we wanted to compare these with the more traditional pay-as-you-go systems, but that are also very well developed. And here we have France, Germany, and Luxembourg as the key countries in our study. Now, to complement this, we wanted to bring in the perspective of non-EU countries. And here kind of the best poster child kind of cases that we could look at was in particular Australia, that kind of has kind of made a mark around the world through its kind of superannuation funds, in particular an occupational pension scheme that has kind of turned out to be extremely efficient, as well as Canada, which is kind of very well kind of known internationally for the efficiency of its public pension system. And so we'll talk again also about that in the case study a little bit down the road. Now, looking kind of briefly at the data to illustrate the fact that these countries all have strong pension systems and that they're fairly comparable in their income replacement rates, you just see here basically some statistics across these 9 countries on the income replacement rates as a percentage of pre-retirement earnings. Now, this here only includes, in our study, the tier 1 and tier 2 component. We took out the tier 3 component because there are some data questions. And you quickly see that in the pay-as-you-go economies, the primary kind of component that kind of adds to kind of the income replacement is the tier one, right? Is kind of the public pension system, whereas in the capitalized or the non-EU economies, you see much more variation in terms of how much of the income replacement comes from the occupational pension plans versus the public pension plans. But on average, right, they all fluctuate around the similar lines. They're all very well developed. There's an average kind of income replacement rate of 66% across effectively these all these countries. Now, if you look at the actual contribution rates, even though all of these countries have similar amounts effectively of income replacement rates, you see that it's actually kind of very different, like big differences in terms of effectively how kind of these income replacement rates come about when we think about the sustainability of these pension systems, right? And in terms of what the contribution rates are by each individual pillar. And so first, if you look at the green bars, right, for each country, that's effectively the contributions, again, aggregated across employer, employee, and states that would come basically, or that would be dedicated effectively to the public pension systems, right? That you see very clearly in the pay-as-you-go systems, those are high, going from 16% in France to 19% in Germany and 24% in Luxembourg. And so they tend to be kind of much kind of smaller in the capitalized or the non-EU economies. We have patchy data, as you see, which is actually another big problem when you look at pension studies on the occupational pension systems, right? But there's some variation across the different countries. But if you look at the furthest kind of bars to the right for each country, and I think there's some coloring issue here that doesn't come out in the webinar, at least on my slide, but you see the individual country, like the savings rates that individuals have in the various economies to supplement kind of the pension income replacement rates. And those also vary kind of dramatically across the different countries. Again, being, for example, 17% in Germany or 20% so 17% in France and 20% in Germany, to like 12% in Finland, for example, or 4% in Australia. So big differences in basically how the income replacement rates are being supported. Now, in terms of coverage rates, which is another important aspect when we think about kind of the capital accumulation over time or the wealth accumulation over time. If you look at the tier one, again, the public occupational plans, you have very broad coverage rates across all of these countries, which kind of again underscores the fact that these are all well-developed kind of pension systems. You have pretty much 100% everywhere except for Finland, where we have 30%, and Australia, where it's 62%, where the access to kind of the public pension system is basically means tested. In terms of the occupational pension plans, again, you see much more variation. In Finland, it's 100%. In Sweden, it's 90%. Whereas in France, it's only 26%, right? In Germany, 58%. In Luxembourg, kind of, we don't have the data on it, but we know it's very, very, very small, okay? And so again, in terms of what we have here, tier 3, that will not reflect the coverage rate, it would reflect the participation rate in the equity market for each countries. And again, there we have big variation where we see very weak participation rates in equity markets by individual households in France and Germany, whereas we have very large equity participation rates in the capitalized economy, for example, 50% in Denmark, or going as high as 65% in Sweden. Okay, so 65% of all households in Sweden have some of their money invested in risk capital or in equity markets. How much, of course, there's a big heterogeneity in terms of some having large wealth accumulation, some having very small investment portfolios, but at least 65% are exposed to some form to risk capital. Now, this is kind of the data and the approach that we're going to take. Now, what we want to do is to look at effectively the risk capital accumulation first in aggregate by taking a bird's eye view in terms of how do these kind of amounts look across the different countries. And then I will pass it on to Sebastien to kind of to tell you a little bit more on the micro level, what drives these differences potentially that we see across the different pension tiers. And so then what is necessary in the second step is to look at individual case studies to really help us understand best practices and also try kind of like see how we can learn from these in terms of helping us potentially get suggestions or like not just in terms of how we should think about pension reforms in Europe or in each individual member countries. So let's start. So what you see here is basically the risk capital accumulation, or the total wealth accumulation across countries and over time. And so what you see here is effectively several messages. So first of all, what I should be saying is that what we have done is to make this comparable across all the countries. We have standardized all of the kind of risk capital accumulation by the active working population. So the way to kind of read these kind of graphs is to say this is the total amount of wealth accumulation, both risk capital as well as non-risk capital, on a per active worker basis. And what you see is clearly, right, so in the pay-as-you-go economies, these numbers appear much smaller. If you look at the last reported date, for example, in France, you're around 200,000 euros per active worker, whereas Luxembourg is a bit of an exception, you're closer to 400,000 euros per active worker. But on average, pay-as-you-go economies typically tend to have smaller amounts of wealth accumulation versus capitalized economies in the blue region here, as well as these non-EU capitalized economies in the pink region. They typically on average tend to have just more wealth accumulation over time. Now, if you look at the split, where is this wealth accumulation coming from, or how is that kind of amount being invested? Let's just focus on the last reported day again, right, where for each country, you see dark blue here and the white on my screen, right, like the way I see it here is, what you see is that, again, in pay-as-you-go economies, the dark blue component, the black component, is much smaller compared to the capitalized economies and the non-EU economies. Now, this dark blue or black component reflects the risky share, with the amount of your wealth that has been accumulated that's invested into risk capital. And just to make it simple, just focus on the red numbers at the bottom, which give you these risky shares. And you see very quickly that, again, the amount invested on average, right, on a per active worker basis to risk capital is 44% in France, 41% in Germany, and 46% in Luxembourg. Whereas if you look at those kind of fractions in the capitalized economy, they're an order of magnitude larger. We have 67% in Denmark, 68% in Finland, and reaching as high as 75% in Sweden. So there are big, big differences into how the capital is invested in terms of true productive growth purposes. Now, what I want you to focus on is now only the dark blue or the black parts. So I'm going to take those amounts out to visualize better the differences in risk capital accumulation across these countries. And I'm going to focus just on the last reported date to give you the cross-section across these different countries. And that's what you see here. So again, this would be only the black part here, the risky assets on the per active worker basis, as a snapshot on the last reported date that we have. And so what you see again here is in France, there's about 92,000 euros roughly on a per active worker basis. In Germany, it's about 66,000. And if you compare this to all these capitalized economy, you see that the average across these is about 209,000 euros on a per active worker basis. So to visualize this better, I'm going to collapse all the capitalized economies into one and to make this comparison a bit easier. And so now you see again, you have France and Germany compared to the average across all capitalized economies. Now, the thought experiment that you can do is to say, well, let's imagine for a second that 30 years ago, France and Germany had adopted the same pension reforms as all of these kind of capitalized economies. So in theory, they should be able to meet that same average. So the fact that there is a big difference, well, that's what's reflecting the risky capital gap, as we call it, and that's basically the shortfall that we have in risky capital. We call that the risky capital that we have. And so what you then see is that, again, so like how big is that gap? How big is that difference? Well, you see that that ratio is about 2.3 in France and about 3.2 in Germany. And so in other words, if France and Germany had adopted pension reforms that are similar to those of their peers, they would have been able to accumulate much more risk capital today in the order of magnitude of 2 to 3 times X. And so on an aggregate amount, taking this back by kind of multiplying this back by the number of active workers that you have in the population, this would mean that instead of the 2.8 trillion risk capital that you have in Germany today, or 2.8 trillion that you have in France, you would have 9 trillion of risk capital in Germany today, as well as 6.5 trillion euros of risk capital in France, altogether being close basically roughly 15 trillion euros. And that's the missing risk capital that we could have to invest into R&D and innovation, infrastructure, right, both digital and green, and to help basically fill this productive capital gap that we have identified between Europe and the United States. Now, the second thing then to look at is to say, well, where is this all coming from? Can you make sense a little bit of how did this happen that these kind of capitalized economies have accumulated so much more wealth over this 30-year period? So to do that, just again, we'll plot for the 9 countries that we have. We'll plot the total accumulated amount of wealth. Again, this includes both the risk capital and the non-risk capital. And we plot that on the y-axis against the aggregate risky share. So again, across all the 3 pension tiers, we'll look at basically how much of that within each tier is invested into risk capital in the public system, in the occupational systems, by the individual households. We'll look at the average of this. And again, I'm fairly I acknowledge that these are only 9 data points, but nonetheless, you'll see clearly that there are kind of a big discrepancies or big ranges in terms of wealth accumulation over time across countries, as well as differences in how much they are exposed to risk capital. And so now over time, as you see, as you have basically accumulated more wealth and you have bigger shares of that wealth invested into kind of risk capital, over time, this will create powerful amplification mechanisms where the gap basically in the accumulated wealth capital will increase for the capitalized economies, right? But also, as you will see later, as you expose more, as you accumulate more wealth, there are spillover effects that you will also invest more into risk capital. And over time, is basically the fact that you accumulate more wealth and you invest more into risk capital leads to these amplification mechanisms that will kind of make your capital grow faster over time and kind of result in these kind of states that we have today where capitalized economies have simply accumulated more risk capital. Now, this gets me to the first kind of 2 takeaways, kind of again, I think on my slide, it's a little bit kind of crooked. It's a little bit kind of, the overlay is not exactly, but essentially what have we seen so far? Risk capital in uncapitalized regimes could be 2 to 3 times higher. And I mentioned the 2 cases of France and Germany only as an example, where we could have, instead of 5.6 trillion euros in risk capital, we could have 15.4 trillion today, had they mirrored strategies of capitalized regimes like Sweden or Australia over the past 30 years. So a huge productive capital gap that could be there to invest into productive infrastructure. The second one that we have seen, the second key takeaway, is that there's capital accumulation and risk-taking that reinforce each other, and those 2 mechanisms actually do create a very powerful amplification mechanisms that help us to get ahead of basically of others and kind of grow our risky kind of capital more quickly. Now, what's now necessary is beyond kind of these kind of quantifying just these differences, which is basically a diagnostic only. We need to understand potentially what are the drivers of this risk capital accumulation within each tier, but also potentially the impediments that prevent us from accumulating capital more quickly. And so there, I'd like to kind of, I'm introducing my colleague, Sebastien Betermier, who will take over and tell you a little bit more about these individual drivers, as well as the specific case studies that help us potentially learn about best practices.
Patrick, thank you, and good afternoon, everyone. We've identified 6 main levers that drive risk-taking in pension and household savings. And so if we go through each of them, the first one is very much policy and regulation. Patrick, if you can click. Here we're looking at very much to what extent is pension participation mandatory versus voluntary. That ends up having a first order effect on overall coverage. We see across countries differences in reserve funding policies. To what extent pension funds are required, let's say, to maintain fully funded funding ratios. We see requirements as well and policies on the overall asset allocation. We'll provide some examples in the next few slides. We see regulations on on the status of the funded status, let's say Solvency II, affecting many of the pension funds in Europe. And we see in some cases some regulatory constraints. So particular risk limits imposed on the funds or geographic constraints, these will all ultimately drive the level of risk taking. So that's very much on the pension and regulation side. The second component, or the second big driver, I would say, is scheme design. So larger plans with scale tends to take on more risk. We see differences in risk taking between defined contribution versus defined benefit plans. We tend to see that the more plans tend to pool risks among members, the more they are able to take on investment risks. We see plans with stronger governance and perhaps greater delegation structures are also able to take on greater risk. And then we also see that the member withdrawal policy will have an impact. So for example, if you're going to be in a situation where it's very easy for members to switch from one fund to the next or to withdraw from one fund to another fund outside, it may impose some liquidity constraints that will prevent you from taking on perhaps too much risk or invest in some of the less liquid asset classes. The third key driver is accessibility. Here we're looking at, well, big differences across countries and how eligible or the degree of eligibility into some of the pension systems. The portability makes a big difference, whether you're able to continue from one job to the next, from one industry to the next, to stay as part of the same plan, or whether you have to switch to a new plan and every single time you accumulate small plans. This will have an impact on your ability to take on risk and keep track of your pension funds. The competition in the markets and the level of fees will have an impact as well in your ability to invest in some of the private markets or actually in equity markets versus staying in cash accounts. And finally, the distribution channels. We see big differences across countries in how easy it is to open up an account, let's say at your bank, or whether you have to go through perhaps more layers of intermediation in order to open an account. These accessibility features will have an impact, first order impact as well, on your ability to take on risk. Fourth key driver is financial education. To what extent are people financially literate? More than literacy, to what extent are they engaged? And importantly, how much do they trust the system, especially investing in long-term investment-based organizations? How much trust do people have that they will get their money back down the road? That will have a big impact on their ability, again, to commit to these investment vehicles. Of course, financial and tax incentives have a big impact. The way you design the perhaps tax rebates, whether it's on the contribution side, on the returns, or on the payouts, these will incentivize or not people to invest in some of these long-term retirement savings products. Same with the tax deferrals. But more than just the tax incentives, of course, employer matching schemes, or in some cases, government co-matching schemes will also have an impact in incentivizing you to save. And then finally, the choice architecture is important. Even if the schemes, let's say, are voluntary, makes a big difference how you set up the choice architecture. Are these opt-in or opt-out? You can imagine in the auto-enrollment type of schemes where you're automatically in and you have to actively opt out, may actually make a big difference in you staying invested in the markets as opposed to perhaps going in a different direction. The design of defaults also makes a large impact. How much risk is there in a default, knowing that usually about 2/3 or 3/4 of the individuals will stick to the default. And then finally, especially as we move to more defined contribution structures, the ability to provide, let's say, new technologies like digital twin technologies that give you a better sense of what to expect with your current investment wealth and how much do you need to save and what you need to earn in order to achieve your retirement goals. This has also a big impact on people's ability to take on risk. So you take on this map, you see these big 6 drivers. Then the question is, now let's apply them to the different countries and let's see in pillar 1 or tier 1, tier 2, and tier 3, how do the countries differ and what are the main drivers in each tier? If we start with tier 1, and what you see plotted here are the tier 1 assets. And in green, you see or in dark, you see the risky assets per active worker on the latest reported date for the different countries. We sort them by the level of risky assets per active worker inside tier 1. And then on the right of the chart, you see the risky share. So again, how much of those total tier 1 assets are invested in risk capital. And what you see is that countries at the top, such as, let's say, Sweden and Canada, and we'll come back to those in a minute, these partially funded schemes have accumulated meaningful reserves per worker, and they invest significantly in risky assets. If you think of Sweden, for example, we'll get to it. They invest almost exclusively in risky assets for the younger workers in their plans. That has a huge impact on the total amount of risky capital inside tier 1. You see other countries. Denmark is a good example, a very, very well-funded tier 1, but you see on the right of Denmark, you see about a 30% risky share. A national policy actually to be more conservative on the asset allocation, and part of that is that, well, the big ATP structure in Denmark, which is fully funded, is aimed to provide a pension for the least wealthy, and so that has driven perhaps a more conservative approach. So very much a national policy drivers affecting the level of risk-taking. We also see the impact of constraints. Luxembourg, for example, risky investments have been limited due to legal constraints that mandate the level of asset diversification and that restrict the investment scope. Okay, and then as we'll get to it in a minute, with Canada and Sweden, the more sophisticated the schemes have become, the more we've seen the direct linkages between that and the level of risk-taking. So we see very much on tier 1, the level of scheme design, policy, and regulation as being key drivers. We move on to tier 2. And again, we do the same exercise. So we'll take the tier 2 assets and we'll sort the funds by the level of risk capital per active worker. We see again that policy and regulation are going to make a big difference. In particular, if you look at the top countries in Australia, in Denmark, in Finland, in Sweden, in Netherlands, employer pension is often mandatory or quasi-mandatory. And so that ends up driving a huge amount of coverage. Compared, let's say, to Canada, where in the private sector, you have very little coverage, but you do see, however, in the public sector, a high level of coverage. So that would explain why Canada is up with about 51,000 on average. Big policy or regulations such as Solvency II, a regulation, let's say, in the Netherlands and other EU markets, it has forced very conservative asset allocations and high solvency buffers, funds investing a lot in bonds, long-term bonds, in order to maintain good hedging ratios and maintaining high funded status. And again, direct regulation on asset mix. If we look at, for example, Germany, there's regulations that, well, equities cannot exceed 35% of plans. So that immediately imposes a cap on what the plans can do. And then we'll get to scheme design when we speak about Australia. A lot of delegation, a lot of use of default accounts with high risky exposure drive a lot of the high level of risk taking in the occupational system there. And then finally on tier 3, what really matters, so these again are more the personal savings. What really matters is very much the use of financial and tax incentives. You see that countries such as Denmark, Canada, and Sweden at the top have higher rates of stock market participation. They also have higher rates of risky share, and these tend to have tax exempt or tax deferred savings vehicle that have been quite popular. Finland's a really good example where when there has been a shift to the capital gains taxation, it has improved the level of stock market participation quite drastically. And then again, the level of financial education has a big impact here on tier 3. When you look at the top countries such as Netherlands, Denmark, Finland, and Sweden, they consistently rank at the top quartile when it comes to financial knowledge. And so that ends up driving a lot of comfort or with risk-taking in tier 3 plans. Now, what's interesting, and Patrick alluded to it earlier, is cross-tier type of effects. So what you see here in this chart is on the y-axis, the risky share inside tier 3. So how much risk do people take inside their personal savings? And you can relate it to, on the x-axis, the total amount of risky assets per workers that people have in their tier 1 and tier 2 accounts. And What you generally find, well, it's not a perfect relationship by any means. What you generally find when you're looking at that scatter plot of the 9 countries is a generally positive relationship. So you find that countries that tend to have more of the tier 1 and tier 2 assets, risky assets, they also end up taking on greater risk inside their personal savings. At the very top of the chart, you see 2 data points. These 2 data points are Sweden and Denmark. These are really interesting case studies. And these studies have been studied by academics who have found that when individuals are enrolled in defined contribution plans, they tend to, within a few years afterwards, start to take on more risk inside their personal account. That suggests that the more individuals are exposed to risk-taking inside the defined contribution occupational account, they become more comfortable and they end up taking on more risk as well in their personal accounts. And so that's interesting. That goes back to Patrick's takeaway earlier, that the way you design the tier 1 and tier 2 may actually have a positive extent or positive effect on how much people are able to take risk in their personal accounts. And that creates an additional amplification effect as you're funding these systems and you're exposing people to risk. They become more comfortable with the concept of risk-taking. Now, that chart is not a perfect chart. And you can see, for example, a point on the bottom right, that's Australia. It's a country with a lot of tier 2 risky assets per worker, but if anything, low risky share in tier 3. And here, what's really interesting is, and we'll get to it in a minute, Australia has a salary sacrifice scheme allowing individuals to save more of their personal savings inside their occupational pension plan. And it's very tax advantageous to do so. And so what you end up finding is when people save more, they end up doing it oftentimes through their super funds than through external products that they can buy on the open market. And so individuals may take on more risk, but you may not necessarily see it in the tier 1, tier 2, tier 3 delineation. And for that reason, it's going to be very useful to keep track of these pillars more on the spectrum, more as a distinct set of pillars, because again, the examples of Sweden and Australia will provide a clear sense that the way you set up the system will have a direct impact on the decisions that people make. Okay, so perhaps what we can do now is dive more into case studies. So Patrick, if you move forward, I'll skip ahead here. If we move forward, we can zoom in perhaps on 3 countries that we've already alluded to. We have Canada, Australia, and Sweden. What's fascinating about these 3 countries, they've all reformed their pension system in the 1990s, incrementally so, but they've taken different paths. So the Canada has very much been beefing up their tier 1 system. Australia has been about strengthening the tier 2 system, and Sweden has been a bit of a multi-pronged approach. So I'm quickly going to go through each of them to show you how some of the different pathways have resulted in a high level of risk capital mobilization in each of the countries. If we start with Canada, Canada back in the 1990s was not doing too well. They were growing liquidity and solvency concerns. The pay-as-you-go system, that was the Canada Pension Plan, amongst other pay-as-you-go systems, was receiving about 11 billion in contributions, paying out 17 billion in benefits. We had the same issues of population aging as elsewhere. The governance was not fully set up. And so at that point, the government established what is called CPPIB, the Canada Pension Plan Investment Board. It is a professional asset manager that operates at an arm's length from the government. The board of directors is independent from the government, and the board of governors set up a risk budget, and then the team has then the complete independence on how to run its own operations. So you had a very, very clear governance structure that was imposed. And Patrick, if you move on, what we find is over time, this has led to an increase in risk-taking. So the Canadian pension model, including CPP, but other funds, have moved very much to in-house type of investing. That has led to a reduction in fees, about 1/3 we estimate. It has resulted in an increased level of risk over the years. And the plan is portable, which means it doesn't matter what job you are, it doesn't matter what province you are, you're continuing to be part of the plan. So that reduces the risk of leakage and it provides scale. And so what we see, if we move on to the next slide, what we see is over time, the plan that had in 1999 about $36 billion in assets, and you can see was entirely invested in fixed income, over the past 25, 30 years is now has a majority position in equities. About $600 billion in assets, has generated about 8% on average return net of fees over the past 10 and actually longer horizons. And so you've had, again, an increase in the level of capital as well as an increase in the level of risk taking. So you've had that amplification effect that has resulted in a large level of capital mobilization. Moving over to Australia. Australia has moved to an occupational plan system. Back in the 1970s, the country was relying a lot on the Tier 1 pay-as-you-go age pension. Only 32% of the working population were part of the super pension scheme. The super is how we call the retirement funds there. In 1992, a big reform was passed. It was a tripartite agreement between the unions, the governments, and the employers. And they imposed a 3% mandatory employer contributions instead of a wage increase. That contribution, if we move on to the next slide, has increased gradually to becoming 12%. 12% with very generous tax incentives. The contributions are only taxed at a 15% rate. That's it. The workers can add to those plans through salary sacrifice arrangements. And the industry funds operate on a profit for member model at an industry-wide level that has created scale. It has brought down the fees. It has been a delegated investment structure with a big default fund and some satellite options to provide choice. And the funds have also pooled resources, especially in infrastructure, to consolidate investments, especially through the use of EFAMA investors. That has again increased the level of scale, and that aligned really well with a nationwide privatization of infrastructure assets in the 1990s. And so over time, what we see, in addition to that, the regulation has been pushing for consolidation and scale. What we see today is that 90% of the workforce is covered by Tier 2 plans. You have about 2 trillion euros today in super fund assets. You have among the highest risky share, but 75%. And today that overall contribution is now 12% of income, generally speaking, to the entire system. So again, we're seeing a high level of risky share and a high level of capitalization, and that has resulted in a very high level of risk capital mobilization. Finally, moving over to Sweden, so was facing its own issues in the 1990s. There was financial instability and a large level of pension underfunding. And so Sweden went and did a whole series of reforms in Tier 1, Tier 2, Tier 3. We'll move to Tier 1 right now. If you move on to the next slide, Patrick. They essentially reformed the whole system in Tier 1, switching to what is called more of a notional defined contribution framework that was linking benefits to the level of contributions at life expectancy. But also, and the better governance structure, so the AP funds that manage the reserve were able to take on more risk. We're again seeing an increase in the risky share. But on the right, we've also seen that Sweden introduced what is called a premium pension system. It's a mandatory DC system, about 2.5% of earnings, where the workers can choose among a set of funds filtered by AP7. The default fund, being AP7, managed by the state, operates a very equity-heavy strategy with nearly 100% invested in global equities. And in fact, for those under the age of 55, there's about 125 equity exposure through leverage. I mean, let that sink in, 125% exposure. This is more than twice what perhaps individuals would usually do on their own, with, of course, a glide path operating. So again, mandatory components, a careful design of a default plan, an equity strategy, and a uniform strategy across the country. So that was for Tier 1. In parallel, for Tier 2, there's been a switch to defined contribution plans, quasi-mandatory because managed by unions. But what's important here is the use of centralized platforms like Collectum or Fora that essentially employers work with, and these platforms act on behalf of all the employers to negotiate fees and provide a menu of options that are cost efficient. So again, you see scale, not so much through the investment platform, but here through the liability administration platform, working on behalf of all employers and bringing fees down. And so similar to Australia, we see that about 90% of workforce covered by Tier 2 plans. We see a high level of risky share at 58%, and we've seen a big decrease in fees since the 2000s. And then finally, Sweden has been very innovative in creating equity tax advantage products, also bringing up financial literacy initiatives. We've seen, in addition to that, then the design of tier 1 and tier 2 plans has led to extra risk-taking in tier 3. And so Sweden today is one of the countries in the world with the highest level of equity participation in the world, with about 65%, keeping in mind that they've also increased the capitalization in tier 1 and in tier 2. And the Swedes are also investing extensively on their own in in risk capital. And so you're having risk capital mobilization across the board. So I'll stop here because I think we're running out of time. But the key insights, I think, from the case studies is, one, multiple pathways that we see to risk capital accumulation. And two, doesn't matter necessarily what are the tier 1, tier 2, or tier 3. The common drivers across the board are going to be scale, the design of cost-efficient investment vehicles, the governance component, the ability to have a professional asset management team, the level of coverage, the level of financial incentives, and the portability. These are all countries that have adopted an incremental approach to pension reform, very holistic approach, some more focused on tier 1, tier 2, tier 3, depending on the context in the country. But we've all seen that in each of these countries and across the board, over the past 30 years, it has resulted in a very high level of risk capital mobilization. So perhaps, Patrick, if you can just bring the final slides on the takeaways. Again, high level of productive capital gap that we see between the countries that have mobilized and the pay-as-you-go regimes. Some amplification regimes, some amplification mechanisms taking place where the more you capitalize, the greater the level of risk-taking. Multiple pathways. The fact that across tiers, we see some spillover effects that add another layer of amplification. Structural reforms implemented gradually over time, and common drivers from the governments, the scale, the portability that are present throughout. It doesn't matter which tier, but these features ultimately, over the long term, make an impact. So we'll stop here, and perhaps back to you, Andreas.
Perfect. Thank you very much. I think it's an excellent report. I think also your key takeaways are quite telling, and I do think they also speak volumes for the ongoing pension debate. Honestly, listening to you, I think I have quite a number of questions, but I don't want to take my, let's say, privileged position as a moderator to capitalize on those discussions and maybe turn on some of the audience's questions that I had. But before I do that, maybe I start off with a question for Corinne, and I hope that's okay. Corinne, look, I'm trying to, what I said before, trying to link your report to last week's policy proposals by the European Commission. Do you think that the study's findings have in some way resonated with the Commission? Do you think that this kind of need for well-funded pension systems is, let's say, sufficiently reflected? And maybe more generally, like, are we moving in the right direction in Europe? I'm happy to hear your views on this.
Thank you, Andreas. So first, I think that the Commission has really taken some bold steps, and they are going in the right direction. And why do I say that? I think first, they are they have looked at it in two ways. First, obviously we know that pensions is in the hands of each member state, but they have issued recommendations to the member states so that there can be best practices and that there can be these structural reforms in the member states, which are really needed. And the recommendations are good, and they are also going in to some of the topics which were discussed today. So first, we need to measure where we are and to get people to agree that there needs to be structural changes. So that's where they are recommending that we have dashboards and we have pension tracking systems so that we know where we are, because a lot of the member states or the people in the member states are putting their head in the sand. Let's be honest. Then the next thing is that they have been looking at how could we get more risk capital or more risk taking in pensions? And I have noted a lot of the the steps which have been taken, which are going in that direction. Let me just mention one. The basic PEP is being redesigned to move away from capital guarantee options, and to include mandatory life cycling investment strategies. And that this basic PEP can be used for people who have no experience, and that can be used as a default option, so that the default option is not directly going into less risky capital. So that's a good thing. And the same for the IROP reform. They are also looking at how you could increase the risk capital side. And in addition, in the basic PEP, they are allowing for 5% in private assets. Now we can debate whether this is the right amount, but at least it's recognizing that even a basic PEP could have an allocation to the private asset markets, which is definitely risk capital. Then if we look at scale, there are a lot of what was mentioned here as well. Scale matters. And we know that we have a very fragmented market or European Union in this respect. And if this would be less fragmented, we could be building scale. And with scale, as was mentioned, you can have more efficient management. You can also increase the percentage in risk capital. So again, on the scale, there are initiatives like looking at some of the barriers and trying to abolish them, so that you can have better cross-border or pooling of bigger assets. Then also on the scale side, they are looking. There have been recommendations on that's recommendations on auto-enrollment, because I think if you have this auto-enrollment functionality, this will bring scale. This will bring more people to invest. Then obviously they are allowing the PEP to be open for occupational pension savings, and vice versa, the IROP to private personal pension. So again, this is to build scale and not have 100,000 small vehicles. Also in the recommendations are tax incentives and the incentive side, which was mentioned, and I could go on. So a lot of the findings are obviously the findings the Commission also had, and they are trying to address them. But let's not be complacent. There will be a lot of work to move into all member states into the directions of getting more funded pension systems. And I stop here.
Thank you very much, Corinne. I think this already gives, both a good connection to this, and also me trying to switch over to some of the questions that we received are actually going exactly in this kind of direction. And maybe I can read them out to the panelists. So here we have, how do you actually manage the transition from the pure pay-as-you-go systems to funded systems for pensions? Because workers will have to continue contributing to the current pay-as-you-go systems while contributing to the newly developed funded systems. Especially low-income earners just don't have enough income to contribute twice. So how do you address the challenge? Should state borrow money from the market to finance contributions for those low-income earners? But then what about the impact on gross debt? What is problematic regarding the rules from Stability and Growth Pact, which put some cap on public and gross debt? So I know, big question, but I think really this question, how do you then tackle this with kind of going to the pay-as-you-go conventions by also looking at this, I suppose, social cohesion factor that is in there? Can I have maybe either Patrick or Sebastien trying to answer that question?
Maybe I can start, and Sebastien, you complement, right? Like I think you're more familiar with this, but it's one of the key takeaways of the study, right? Where we kind of highlight explicitly that none of these kind of reforms was like a one-shot reform. These the key takeaway is these reforms have happened gradually over time, right? And I think if you look at Sweden, for example, that has really reformed across the three pension pillars, right? They started out with their kind of the tier one, as we call tier one, or the pillar one, if you wish, in the public pension systems, where they reformed kind of the risk limits on the risk kind of capital allocations across the different AP funds. Right? They later on introduced kind of these AP7 funds, where slowly kind of the mandatory contributions were increased over time, not in one shot, right? But slowly also, there's also kind of a behavioral aspect there, right? That you kind of do it slowly. So going from, I don't know, from like 7 to 8% is not the same as going from 7 to 15%, right? But so over time, these are changes, and these are like then kind of through mechanisms invested into a way to kind of to accumulate more risk capital for the individuals, while empowering the individuals still kind of to take on essentially more risk by like through their own decisions, right? So AP7 is basically driven by an individual decision-making process. The same for the occupational pension plans in Sweden, right? These were gradual kind of progresses over time, where these kind of scale and efficiencies has been built over time through different types of decisions. It's not like a one type reform that kind of came up with the first best kind of solution at once. And the same for then at the household level, right? So kind of there's different types of tax incentivized products that were introduced at different points in time. And so overall, I think that's one of the key takeaways. It has to be done gradually, right? Because there's also an issue of resistance, in particular in places where you have geographical fragmentation, you have political fragmentation in Europe, right? But these cases resonated very well. I mean, I talked about Sweden, but think about Australia, you have different provinces there. Think about Canada, different provinces there, right? Where you have similar kind of geographical as well as political, potentially kind of fragmentation, but yet they have achieved it, right? But all these cases show essentially gradual kind of reform over time. And Seb, I think perhaps you want to kind of complement that with some of your observations.
Yeah, so in Sweden, it took about 20 years to get that reform implemented gradually, step by step. Canada just recently increased its mandatory contributions to the CPP, fairly significant increase of about, if I recall, 3 to 4% of income over time, but that's spread out over 6 years. Australia started with 3% of income paid by the employers. 20 years later has moved to 12%. So these are baby steps that are each important, but incremental. That's one. And I think you've also said it, Andreas, likely you need multiple tools going on at once. You may need to use debt financing, potentially at the states. There's a limit to what you can do. Potentially help out some of those who are in are in that most difficult position, or use some of the debt financing to establish perhaps a more efficient, cost-efficient vehicles like a CPP that is able to obtain higher returns and play catch up. The more we have multiple levers and we have a horizon to work with. So that gives us tools that we can use to reduce the impact on the populations over the next 20, 30 years.
Thank you very much. Sorry.
Just to complement this, Andreas, one more thing, I think, because there was a long question, right? There was also the issue about financing this and the sustainability of these mechanisms, right? And I think what's interesting cases as well in our study are both Sweden and Denmark, right? That have actually come up with automatic stabilizing systems in the public pension domain, but through very, very different ways, right? So, and that's enshrined in the Constitution. So I think that's also important from a government's perspective, because it's predetermined what's going to happen once the system is no longer funded. In Sweden, for example, if the system is no longer funded, there's an automatic increase in the contribution rates, whereas the stabilization mechanism in Denmark is very different. It's where the pension age is going up. And so very recently, they have actually increased the pension age to 70, right, which is kind of, I think, the largest in the European Union. But there's different ways of also dealing with this, right, which kind of also are important.
No, look, definitely. I think all of this is also the problem, how multifaceted all of this is. Maybe there's one other question I'd like to pick up from the chat. Of course, you've been focusing on several specific countries. So in the chat, I've also seen, questions on why those countries were picked. As an example, was also given that in Latin America, countries like Chile, Mexico, Colombia also recently have done some improvements to the pension systems. My question to you would be, I would assume that just because you haven't picked certain countries, that was probably also a question that you had around data availability, or have you seen, for example, other examples in other countries that weren't part of your study that also showed very good, examples that one could take a look at it, maybe a second iteration, in case you're bored in the next couple of months?
Yeah, so it became really clear as we did the study that gathering the data and across all the tiers is hard. It's hard because it's all over. So it took us a lot of time actually to aggregate that data together, which is why the whole recommendation Corinne mentioned about the dashboard and the tracker, if we can get that to work, would be huge, because we can actually get to measure it on a more continuous basis. And so that has limited in a way the total number of countries that we've looked at. There's certainly other countries who have done really interesting reforms. South America, certainly. One closer to perhaps Europe is the UK. Nest and auto-enrollment has been, in my view, a very big success. Since 2008, the level of coverage in the private sector has gone from 30% to 80% using an auto-enrollment strategy. So we're not having mandatory pension coverage. If individuals want to opt out, they can opt out. But again, going back to the choice architecture, if you design it well, you can create scale and provide even hundreds of small employers that wouldn't have easy, cost-efficient options otherwise, suddenly access to one cost-efficient savings vehicle. And so I think there's a lot to learn from what we've seen there in the UK.
Perfect. Thank you very much. Unfortunately, I have a number of other questions coming in, but I also have to tell you that unfortunately we've kind of run out of time and we're at the end of the webinar. I think if participants want to take something away from you, you had those very great takeaway slides, so I don't want to repeat them, but certainly what has stuck with me that, funded pension systems certainly outperform pay-as-you-go models. In a way, looking at this, the glass is half full. Those countries in Europe who haven't done that, I think, have a unique opportunity to also unlock those trillions of productive investments they can do for pension reforms. But of course, as we just discussed, I think the road to this, of course, there is no single silver bullet, but all those are baby steps that at some stage over time, over a long time, accumulate to something very important. Maybe for those of you who are interested in hearing even more about pensions, there's still a couple of events for this year's European Retirement Week that I just want to draw out to you. So on Thursday, we have Better Finance and FESE that are holding a conference on turning savings into long-term growth. On the same day, we have Pensions Europe and others who will host a joint event into rethinking how we should best communicate about pensions. And on the 2nd of December, so apologies for this, technically next week, but simply because the European Parliament is currently in Strasbourg, Better Finance is hosting a conference titled Mind the Pension Gap, which is hosted at the European Parliament. I've also seen a couple of questions on this, so we are more than happy to circulate the recording of the webinar to all participants. We'll also make sure to make it available on our website together with the excellent study as well. With that, I think all that is left for me to do is thank both Patrick and Sebastien for the excellent report and the great webinar. Thank you also, Corinne, for providing, I think, some valuable background, but also trying to connect all of this to the ongoing EU policy debate. Last but not least, I think thank you to participants. For what I've been seeing in monitoring the participation numbers, people held on to this, which also I think showcases that there was quite a high quality of what was being taught here today. So with all of this, I hope you found the webinar as interesting and the discussions as I did. And with this, I wish you a wonderful rest of the day. Thank you so much and goodbye.
Thank you.
Thank you.
Bye.
Thank you. Bye-bye.